Hey, folks, welcome to InTheMoneyStocks.com's intraday analysis video brought to you by the creators of proprietary price, pattern, and time methodology. Learn the PPT strategies and profit for life. My name is Gareth Soloway, Chief Market Strategist here at InTheMoneyStocks.com. All right, guys. Nice solid down day on Wall Street. Not entirely surprising considering these aspects. Let me go over it. First off, we talked about the big surge on Friday off of the jobs number, the ISM number, and the bottom line is I don't think it was as much to do with the economic data as needing the market to close about above 14,000 on the Dow Jones Industrial Average. All right, so again, the market into the end of the day squeaked above 14,000. What do we know about these levels, folks? When a market closes above a key level like 14,000, the media pumps it all weekend long. Average investors flock into the markets. They go out on Super Bowl weekend and buy new TVs. They buy more food. They spend, which is good for the economy. So there's actually an incentive to have the market close above master levels like 14,000 on the Dow, 1,500 on the S&P 500 on a Friday. And interestingly enough, last Friday it was the Dow at 14,000. The Friday before that was, believe it or not, the S&P 500. So again, it's somewhat of a little bit of a shady activity that on Fridays they happen to get these levels closed above, but that's the nature of the beast. Today we're seeing a massive reversal. So just as the little investor comes to the market and puts their money in, and by the way, inflows in 2013 here in January have been the highest inflows week after week since 2002. Another 18.8 billion in inflows. That's a billion with a B in inflows of retail money, which is the average investor, last week alone, folks. We're probably talking about 60 to 80 billion dollars in market movement in volume of money coming in from the average investor. That's a lot of money for just a few weeks. That is absolutely a huge amount of money for just a few weeks. So the big question remains, once the average investor's in the market, does that mean the market has topped? Today, it sure looks like that. The negatives about today in terms of the market, you have a full-fledged 100% retrace of the entire move from Friday. So here's where we were Thursday at the close. Here's where we were on Friday at the close. Today we're right back to that exact gap fill. We're actually a couple pennies below it, but per the negation of Friday's move. And again, when you negate a move, and especially when you're at 52-week multi-year highs, and you do that on a big move up and then you reverse it with a big move following, that's known as a engulfing candle of sorts. Not a full engulfing here, but at least a reversal candle. And reversal candles very, very bearish on the market, guys. Very, very bearish. So my guess is, as long as they don't rally this thing up later in the afternoon, this probably begins a little bit of a micro correction in the market. Just a micro correction. Nothing crazy. I'm not envisioning, a 10% drop in the equity prices by any stretch, but I do think the market, if you go to the daily SPY, does show a correction is needed. Again, look at the move up just in January. Finally, we're coming down. By the way, notice how this low, remember last week we had 2 down days in a row. They were small down days, but that was the low of last week's down day before Friday's big up move. Look at where we're stalling at the lows. I mean, if I go back to the 10-minute here, you can perfectly see it's right at that double bottom level. So that's a big level of support right now. That'll be the next level you watch for on a downside to see if it gets taken out. If that gets taken out on the downside, this market could and should correct to easily the next spot would be 149. And I actually think we'll go all the way down to about the 147.5 level following that. The daily chart confirms that here with this. See this pinkish line, purplish line with the 20. That's right around 148, 147 and change. So that's most likely, if we continue to move lower, the short-term level on the market that should be hit. Okay? So that's what we have going on. Please notice this, guys. This is extremely important. Take a look at the high from 2011 connected to 2012 high, and look at how on Friday we closed above that level. Now, again, if you've taken my success webinars, Elite Methods to Ultimate Success webinar, you know that a close above means jack, you know what. It means absolutely nothing. It's all about confirmation. And again, members who have taken that webinar know that it was a fake out, very probable on Friday. And sure enough, today we're seeing that. So again, close above a level is not a breakout. That's what fools think. That's what amateurs, that's what retail investors get caught on the wrong side of. This is a great example of what's going on today. The proof is in the confirmation signal, a proprietary method here at InTheMoneyStocks.com. If you know the confirmation signal, you're a profitable trader. I mean, that's just all it is to it. Swing trader, day trader, investor, I don't care. You know confirmation, you're going to be profitable. Just that simple. That one proprietary method. So sure enough, we closed above this level on Friday. No confirmation. I've been calling for a range on the market between 150 and 152 on the SPY. Guess what the high was on Friday? 142, 150, 142. Didn't quite get to 152, but you're still stuck in that range between 150 and 152. Right now, we're actually trading below 150, which again, a close below that level could be significant, especially if it takes out the low from last week here in the short term. So some crazy stuff going on. And again, the beauty of this is, guys, I'm just going to reveal exactly what's going on. Pacific Ethanol, PEIX. Gave this to my research center members a couple weeks ago at 35 cents. We sold today at 45. 30% gain approximately on PEIX in a matter of a couple weeks. That was on the long side on a down day on Wall Street. We nailed this move. I knew this was coming right to the 200. That's exactly where it went. All right, now the other factor here is even more interesting because now I have a bunch of shorts that I've accumulated with my research center members, whether it's Dish, which is down, check this out, down 84 cents today. Beautiful drop there. We're in the money on Dish. DIA, obviously in the money here as this thing comes down beautifully. And another one, 3M, down 75 cents in the money there as well. So again, just the accumulation, smart money, utilizing the proprietary strategies of accumulation, of key level setup, price pattern and time, which is the PPT strategies, the proprietary strategies we've come up with. That enables us to get on the right side of the trade 80 to 90% of the time. There's always going to be one little outlier because you get news popping up or whatever happens intraday, stops you out, so be it. That's okay. If you can bat 80 to 90%, you are better than every single hedge fund or money manager in this world, folks. I'm telling you that right now. There's no hedge funds doing that type of trading. Trust me on that one. Even Goldman Sachs ain't doing that. All right, guys, going back to the SPY again, let's take a look. Down $1.48. You continue to trade right around that gap fill level, which is a negation of the entire move from Friday. Take a look at Apple. This was a great call on Apple from last week. I told my members, and I think I even mentioned it in the free video Friday afternoon that I put out to you guys, that Apple was weaker on Friday than the market, and this is a very important trade lesson. Apple closed lower on Friday, and the markets had a huge rally. What's wrong with that picture? Well, if the markets are rallying, a stock that is neutral with the market should be rallying as well. Apple was down. That told me that Apple would remain weak here early in the week. So sure enough, what happens to Apple today? Down $9. Well over the percentage the Nasdaq's down. Same thing with Amazon, guys. Amazon is down over $5 today. Friday it was down. If Amazon and Apple cannot rally in a strong market, if they still close lower, the divergence there is to the negative side. They're going lower. All right, and again, you're seeing that today. Even with the markets lower, they're still going down, and it is a beautiful thing. Being on the right side, being able to pinpoint trade levels, it is everything to me in terms of profits. And the profits continue to flow today per the Research Center. Now, the Research Center is geared towards swing traders and investors. If you're a day trader, you go to the intraday stock chat. There's a 7-day free trial for both here at InTheMoneyStocks.com. My only sense is learn the PPT strategies. We'll teach you it. I'll give you my calls. I give you my alerts and the hot charts and alerts inside the Research Center. You'll get trade alerts and everything. But I want you guys to learn this. It is the most powerful thing you will learn in your life. Promise you that. Take care, folks. Have a great evening. Come visit us at InTheMoneyStocks.com.